there's no comparisons to these things that used to go on the in the desks of the olden day banks for anybody that was around back in the 90s, for example, because the deals were set up on the fly. The deals were set up over a phone. The deals were set up in a conversation where somebody would do something for the benefit of somebody else, and there would be a bit of a backhand on it. There would be a bit of a deal agreed with them. These were the way that deal makers made their hundreds of millions, if not potentially billions of dollars. The LIBOR situation where everybody, it was normal. It was just the way it was. It was very much like, looking back and trying to revise history. You can't, because it's what was accepted as normal. In the olden days, women used to not have a vote. You can't say now that it was bad, because in the olden days, that's what was normal at that point. Whether it was right, whether it was wrong, by today's standards, that's the way that it was seen at that point. And it's very, very difficult to try and look at how institutions trade now compared to the way that they used to trade in the olden days. I mean, for example, if you were going to have a loss and you were one of the lead traders, then obviously one of the things that happened, of course, was that you just passed that loss on to one of the unknown accounts, if you like. There was plenty of them, and some of the more seasoned guys have been in institutional banking probably know what I'm talking about. There was a series of accounts you could just pass a loss onto so that you could actually continue to make your commission payments, for example. And that's how it worked. If you were going to take $100,000 loss or $1 million loss, all you had to do was sell it to one of these other accounts. It would be written, that other account would be written off to the bank's profit and loss account. You'd make your $1 million commission, or your $5 million commission, or $50 million commission. You'd make your big commission. And that loss was basically written off to somebody else. You passed it on to an unknown. And that's the way it used to always work, and that's the way it's always worked. And a lot of people don't realize that most of these deals were done behind the back door, behind the shed, and they were the smoke-filled rooms of people discussing how to make a quick killing. And there's no way these guys could trade like retail traders, because it was a different world. They weren't using charts. None of it was about charts. It was just about supply and demand. It was about volumes. And when you think about it, when you stop a second and think about it, it makes a lot of sense, because that's the way business works. It's who people know, it's your connections. And the pits, it used to work like that as well. The pits guys will tell you that it wasn't about going into the pits and having the best strategy. That wasn't of any interest at all. One of the most interesting parts to the idea behind the pit was very, very simple. Were you able to catch the eye of the brokers opposite? Because if you couldn't catch the eye of the brokers opposite, you can shout all you like, they're just going to ignore you. So the pits were about building relationships. The pits were about doing each other favors every now and then when a favor needed to be done. Give me a nod the next time you're going to get one of these trades. Give me a nod when you're going to get another bit of business here. Give me a nod. Give me a nod. It's like the present day horse racing industry. Give me a nod when you're setting up a plot. And I was talking to the guys about plot horses this morning, about how we look for plot horses in terms of the algorithms that we use to try and find where a plot horse is going off. Because one of the things that you guys may or may not, if you've ever owned a horse, if you've ever been involved in horse racing, one of the things you may or may not know is that when you buy a horse, you don't make that much money in prize money. And obviously the costs of stables and jockeys and trainers and all that kind of thing, this is a very expensive hobby. So you have to land a plot. Now, how do you land a plot? Well, you get a horse, you train the horse, you see what kind of quality the horse has got, and your job now as a trainer is to try and get the horse plotted up to do 1 or 2 big killings, because you can only do 1 or 2 big killings per horse. And obviously, it's got to pay off. It's got to pay for the remainder of its time at that stable, for example. So you're looking to try and make a £20,000, £50,000 winner on that one horse, if the stable fees and the costs and fair, all these kind of things. And it's about pitching your horse at the right level. So if I've got a horse that's weighted at 95 and I can get it into a race that's weighted at 70, I've got a massive advantage against the other horses. The only challenge I was saying to the guys is that the bookmakers might know about it, so they price it so that we can't ever get value in it. Secondly, there might be other horses in a similar position in exactly the same race. So there's always that chance that even although you start putting some big money at risk, it still might not be good enough to make the big gains that we're looking for. I showed the guys just a quick clip of a couple of horses we took on Friday, and it's based around this process here where I'm trying to get the biggest number in the top right hand corner. If that number is bigger than 10, I've got an opportunity to make a bet because I've found a horse that's now weighted at £10 or better according to the algorithm, that's weighted £10 or better than the nearest candidate. So when I find a horse that's rated at nearer 10, in this case the horse is actually rated way above 10. The horse is actually rated about £22 ahead of its nearest opposition. £22 is almost a banker bet. Well, on that basis, I'm getting 3-1 my money. Well, that's a brilliant bet, isn't it? If I'm getting a horse that's £22 ahead of its nearest rival, and I'm getting 3-1 my money, you'd normally be expecting to get, 1.5 or an American number 0.5 your money, and I'm getting 3-1. That's an enormous edge for me as a punter. This one here has an edge of plus 12 against its nearest opponent. And again, that horse comes in nearly at 3-1 as well. So another big edge, not as good as the first one, but another big edge for me as an algorithm. So when we put these algorithms together, we're starting to ask those questions. Is this horse subject to a plot? If the horse is subject to a plot, have I got a price? If I have a price, am I going to take a trade? Because just because it's subject to a plot doesn't mean, of course, that I'm going to get the right price on it. That doesn't mean I'm going to get the right money down on that horse. But it is an opportunity for me to make some cash on the horse racing. And yes, I've shown you two winning examples. Of course, there are occasionally examples where we don't win, and we just have to accept that. That's part and parcel of the game, isn't it? It's part and parcel of the game. We just have to take it on the chin when it doesn't win. But, because you don't know who else in the race is trying. Our job is to try and plot out the path of the horses that are trying, and we try and make the best decision possible based on those narratives. I'll give you an example. We had a race just there, and my selection was a horse called Medway. We had it 10 points clear of the nearest rival, and we had it at 3-1, and it came second. So we got our money, basically got our money back with a small loss. So it goes, it's at the end of the day, you can't guarantee that you're going to get the horse on form, and your job is really just not to necessarily do that. It's just to play the numbers. That's all you're playing, is playing the numbers. Well, trading's the same, guys. You might get all your numbers lined up perfectly, but if somebody's doing a backdoor deal, well, there's nothing you can do about it. Absolutely nothing you can do about it. And there's no point you trying to do anything about it. There's no point you thinking about it. There's no point you worrying about it. You're never going to be able to do anything about it. And as a result, you just have to say, well, fair enough. Write it off and move on. Write it off and move on. I was just looking through to see if there's been any other horses running that we've had an interest in, but I don't see anything yet that we had a particular interest in so far this morning. Nope, there's not been any real plots. But it's pretty much the same as trading. You don't know what's going on in the background. You don't know if somebody's just going to come in with a very large bidder offer because they've got another reason to be long or short the market. I mean, oil's a cracking example of that because oil's manipulated massively. Gold is a massively manipulated market. You've all heard about the silver manipulation, the cornering of the silver markets back in the day. Every market's got its big players, and you might argue that every market therefore is massively manipulated, but the markets that are difficult to manipulate or the forex markets, but they're still manipulated by the central banks, the biggest player of them all, basically. And that happens on a daily basis as they adjust to positions as well. So, there's a lot of manipulation that takes place, guys. A lot of stuff going on in the background. Anyway, we've had quite a sell-off at equities at the cash open today. They've gone short, taking the market down literally right from the gun. So there was no gameplay to the top side. That was a bit disappointing. And obviously it's now a case of waiting to see if we can pick up any particular signals that might generate a nice reversal. I'm thinking still on the buy side of the book. I like the fact that they've taken it down at the open. I was kind of half expecting it to do that, and I would explain why that's the case. But they have taken it down quite easily and ran some stops, early diddles, and I think that's pretty obvious that that was what was going to happen. And as I said, I'll explain exactly why that's the case. It would be nice to now see the price doubling back against that, because that's what I now would expect to happen, based on the article perhaps that you read in the Smart Alpha folder. Yeah. Well, I think oil just looks like a rotational market. Most of the time so far that I've seen, certainly the oil price has been rotational from a book point of view. The bottom edge, the market buyers have come in from the halfway trade in and above. The sellers have been on top of the book. And it has done exactly that. It's just rotated backwards and forwards behind these two rotations. We see the top edge forming still. We've seen a bottom edge forming off these 45s. So to me, Rick, it's just been rotation. It's just been a very, very simple rotational piece of business transacted so far. So here it is here. In terms of book, you can see that a normal market maker's book looks like what before we go on to this? A normal market maker's book looks the opposite to price. That's what a market maker's book looks like. Price goes up, market maker book goes down. Price goes down, market maker book goes up. What does a commercial book look like? A commercial book looks like this. Price goes up, market maker is bullish. So that's what a bullish book looks like. So this is a rotational book. And obviously based on a rotational book, the best place for liquidity in a rotational book is where? Where's the best price for liquidity in a rotational market, Cliff? Give you a clue. Cliff just took a trade. Top edge and bottom edge, right? So from a liquidity provider's point of view, the best trade, the best place to get a rotational book sell is off the liquidity highs. So we can already recognize that with the market maker book going bearish here, and it's very bearish as we come up into the top edge, we can already recognize that there is an incredibly high probability that we get a little shape there. We get a incredibly high probability that we're going to get a short trade up against that liquidity high up here. And it's the same into the lows. You can see that as we go down into the low prints, the same thing happens. When the book goes bullish, we start looking for the absorption prints. We start looking for the liquidity. We don't get any absorption prints here, so the price rotates. We start to see some absorption prints in here, and eventually we get that very, very low priced absorption print when the book's now bullish at lower prices, bottom edges. Book's bullish during this period here, lower edges, liquidity, absorptions, bottom edges. Buying against that book liquidity makes an awful lot of sense. In fact, this is one of the subjects we're going to be covering in today's Monday Club, of course. Does that make sense to everybody? So the book liquidity is incredibly important to us. We've just got to make sure that we know what the book liquidity is telling us at certain points so that we can adjust accordingly. And that oil is a great example of that type of market scenario, isn't it? It's a great example of those types of trades. It's same as gold, exactly the same as gold. We've seen that buyer coming in equities, as I expected. I was quite confident that we were going to see the buyers coming back in. You'll probably understand that if you had been in this morning's classroom. We talked about it at length, in fact. about that buy signal coming back in the market space here. So we've done well.